Welcome everyone. I think a lot of you already know me and Belong. So I'm the co-founder and CEO of Belong. We are an NRI savings and investment platform, specifically focusing on Gift City. I'm a second-time fintech entrepreneur. Have been in this space for more than a decade now, and we have been doing this Gifted Insights for a while now. This is the ninth episode, and for this. We are very excited to have Naman, who is an experienced international taxation expert. He has been doing tax filing for NRIs for almost a decade now and handles all the litigation and all till the ITAT level. So is uh, an expert, and we are looking forward to this session. Naman, this has been a very hotly debated topic also,
Correct.
especially with a lot of publications covering the exemptions recently. So yeah, let's start. So Naman,
Yes.
over to you. We can get started.
Yeah. So thank you first of all everyone for joining in the session and looking at the awareness of people who are actually having some interest in knowing the taxation part, because generally it's a very boring part as we understand. For anyone who is not into taxation, they feel that it is either very complicated or very boring. So yeah, I'm happy to see that 40 odd people have joined for this session, and let's try and discuss, because now as earlier also someone said that there are lots of information available, but we don't know what is correct, what is incorrect, and because of this data and everything, and because of something which is available, and we are in the flood of data. Correct, everything is being posted on every LinkedIn. Let's say some newspaper is making some headlines that okay, this has been done. So we have lots of information, so we'll try today and keep it as concise and as let's say a very precise thing on how taxation will work for especially people who are living in UAE, for them in relation to capital gains, because those are the incomes, the passive incomes which they are earning from India, capital gain income, interest, dividend, etc. There could be something which is still not very much clear, because in taxation it's always about interpretation. Nothing is black and white. Correct, some things are black and white, but some things are there is always some gray areas. So we'll try and cover those also and see what our interpretation could be. Correct. So now moving on to the first slide. Now, who is a non-resident? Yeah, correct. So the first question which comes is that who is a non-resident? Correct. So there is no specific definition of non-resident which has been prescribed under the Act. It is the thing that has been prescribed is what is a resident, and then all other people are non-resident. Correct. So in simple sense, if we understand, for people who are moving outside India for the purpose of employment, business, or anything, if you stayed in India for less than 183 days, you are a non-resident for India. That as simple as that. There is no other things that you need to keep in mind. It's just the number of days initially, but there are other complications. We'll see ahead what are the other things that you need to keep in mind. But for a simple one-liner answer, it's 183 days for people who are moving outside India for either employment or business. Correct. Now moving ahead. Yes, so as I said that it is a bit complicated, because you see this is the flowchart that I tried to create, but again it's very complicated. So we'll skip this because we don't want to discuss on residential status. We are assuming that a person is outside India and he is a non-resident for India. So now moving to the next slide, we'll understand that in case of a non-resident, when they have to file a return of income, because what we generally get as a questions from many people is that अच्छा सर, मेरा तो आई एम अर्निंग 1 लाख रुपीज, मैं तो 2 लाख रुपए इंटरेस्ट कमा रहा हूँ, शुड आई फाइल द रिटर्न और नॉट, मेरा तो टीडीएस डिडक्ट कर लिया. बिकॉज इन केस ऑफ अ नॉन रेसिडेंट, more or less on every type of income, a TDS will be withheld in India. And it is not just India, correct? If you're living, currently we are speaking with non-UAE persons because they don't have taxation, correct? So it might be difficult for them to understand. But if we look at any other for foreign territory, let's say for example a US, or let's say a Germany, anywhere, everywhere there is a rule that for non-residents there are very specific rules for withholding of tax, because generally it becomes very difficult for a government then to catch them and take taxes from them, because they are living outside India in a foreign territory, correct? It becomes difficult for them to get tax from them. So always there is a tax withholding for any type of non-residents. And again a very common question which we get every time, that last year I was a non-resident, so how will my residency be checked this year? So checking residency is a every year exercise. It is not that once you are a non-resident you will remain non-resident forever. You need to every year check based on your number of days. And after the period of COVID, it has become a very difficult thing that even if you are working for a maybe employer outside India, you might be sitting 6 months in India on a vacation or a work from home, or such kind of things. Correct. So you need to check that whether if you are in India, how many number of days you have stayed in India. Otherwise, it could happen that your global income will become taxable in India. So very important point number one, check your residency every year, and always keep in mind that how many days you have to stay in India. Number two, when you have to file a return of income. So नॉर्मल थॉट प्रोसेस ऑफ एनी इंडियन, अगर आप अपने लेट से आप अपने फादर से पूछेंगे, मदर से पूछेंगे, वो माता सॉरी फादर फादर से पूछेंगे, कोई और अपने अंकल से पूछेंगे, वो बोलेंगे हाँ ठीक है 2.5 लाख के नीचे इनकम है मत भरो रिटर्न, ठीक है ना, बिकॉज सबके लिए वो लोग सोचते हैं रेसिडेंट की तरह. बट फॉर नॉन रेसिडेंट वी नीड टू कीप इन माइंड दैट द language which is used is says that income does not become liable to tax, which means that in as we have discussed earlier, in non-residents every income is being charged to tax at special rate income and other income, correct? So आपकी जो भी special rate income होगी ना, capital gain हो गई, या फिर और कोई आपकी मान लो you say that we are earning some technical services from India, we are giving some Indian companies some services. So in all those cases, your incomes are at very special rates. If in case you are earning capital gain from property, shares or anything, it is advisable to file return every year in India. And even if let's say for example, you are not having any taxable income, आप बोलते हो मैंने तो shares में invest किया, I had a loss. चलो मार्केट वॉज वेरी डाउन लास्ट 1 year 6 months, तो हमने बोला चलो लॉस हो रहा है, हमने लॉसेस बुक किया, हमारी तो कोई इनकम ही नहीं है, तो वाई शुड आई फाइल रिटर्न ऑफ इनकम? करेक्ट. इन दैट केस ऑल्सो वाई इज इट इंपॉर्टेंट टू फाइल रिटर्न ऑफ इनकम? बिकॉज देर आर टू बेनिफिट्स दैट यू आर लूजिंग ऑन. नंबर वन, एक तो आपको लॉस का बेनिफिट जो आगे मिलता है बाय फाइलिंग द रिटर्न ऑफ इनकम, यू आर लूजिंग दैट बेनिफिट. सो यू हैव टू पे टैक्स ट्वाइस. एक तो आप आज का जो बेनिफिट आपको मिलता है लॉस का, दैट यू आर लूजिंग आउट. एंड द सेकंड थिंग इज दैट when in future you will earn capital gain, you won't have the loss to set off against that gain, so again you will pay tax on that. So these are the benefits that you are losing on, number one. Number two, the government will only have the records 99% of the shares that you have sold. So let's say for example you have sold a shares worth of 20 lakh rupees, and against that you had a purchase of let's say 25 lakhs, so you are saying that I am having a loss of 5 lakhs. However, the government will only see that you have sold shares of 20 lakhs. They won't calculate your cost. It's your responsibility to give the cost to the government. Correct? So it is always advisable, even if it's a loss, always try to file your return of income. And it is again a very much benefit when you return to India, because you will have all your returns filed till the date, and all your records will be complete with the government. Now moving on to the next slide. So the deadline is also a bit confusing. Till normally it's 31st of July as we have mentioned, but for this year, due to some technical issues with the income tax department, it has been moved on to 15th of September. And till now also the ITR forms for non-residents have not been released. ITR 2 and 3 that have not been released till now, but we are hopeful that it will get released in next 1 or 2 weeks, because for residents they have released the form ITR 1 and 4, but for non-residents which are useful is ITR 2 and 3 that have not been released till now. So the due date is 15 September, but as soon as the forms get released, we'll start filing the return of income for all our people. Yes. Next. Now India UAE DTAA. Now again, many people have this question. Maybe some have been dealing this for like say 5 years, 10 years. They know what is a DTAA. There is a double tax avoidance agreement. But many people who might have just started their jobs in UAE, or who are just new to the tax field, correct? They might not be knowing what is a DTAA. So just a brief background is, double tax avoidance agreement is an agreement between two countries, because whenever there are two countries involved in taxation, you need to have an agreement which will bifurcate the taxing rights between both the countries. Correct. So it is double, as the name suggests, double tax avoidance agreements. So none of the country's residents want their income to be taxed twice in any country, correct? And none of the countries would also want that, because if that happens, that people will start leaving that country, start leaving and moving to a new country, because if they are paying tax in a source country and a resident country, and they are paying double tax on the same income, they won't like that, correct? So similarly, India UAE also has a double tax avoidance agreement, wherein it was signed in 1993, which only what it does is that it restricts the rights of both the countries, that on what income which country can charge a tax, correct? There are no tax rate prescribed as such in any of these agreements. This only restricts the rights. Moving on to the next slide. Now, as per the
Namalji,
yes, Ayush.
sorry if I
Yes.
intervene and if I may ask. So
Yeah.
I'm staying in Qatar. Earlier, I was in
Okay.
UAE. I was working with
Okay.
Etihad Airways. Now I'm working with
Okay.
Qatar Airways. My question to you
Okay.
is, in Qatar, I don't pay any tax. So, and still the DTA is
Correct.
signed. So, I mean, how it's beneficial for me in terms of implementation, in terms of
Correct.
mutual
So
fund and
similar
stock
situation.
investment or any other investment?
Yeah, so it will be a similar situation for UAE also, correct? So UAE also does not have the tax for their individuals. They have recently introduced for corporates, but for individuals there is no tax. So how we'll cover is that you are still a tax resident of Qatar, because you are staying in Qatar. You are having a permanent base in Qatar as of now. You might be coming to India for some number of days for your vacation or anything, but still you are working in Qatar. You are employed with a Qatar person and you work there, correct? You stay there for a maximum period or a 180 to 100 days of
Yeah,
period, correct? So you are a resident of
yeah,
Qatar,
yeah.
correct? Now how the taxation would work, it will more or less be similar to what we'll do in UAE, and we'll discuss it, how your capital gain in mutual funds or interest or dividend would work. And I would say in a majority of the situations, your taxation and the UAE taxation would more or less be on a similar footings, which we have in the future slides. I'll just take your 5 to 10 minutes. We'll just discuss that, and if still after discussing those points, if you still have any queries, we'll surely take that queries in next 10 to 15 minutes, if that's okay.
Sure, sir.
Correct?
Thank you.
Yeah. Okay. Now moving on to India. Correct. So as I've discussed earlier, India talks about residency based on the number of days that they are in India. Correct. It's very simple. It's 60 days, 183 days. As we have discussed on the flowchart, it's very complicated. But to make it simple, I'll just give you, because most of the people would be moving outside. As Ayush also said that he's working with an airlines outside India. Correct. So many of the people would be moving outside India just for the purpose of employment. Correct. So for them, it is very easy to keep in mind that whenever you are moving outside India for employment, you need to check that whether you have stayed in India for less than 183 days or not. Correct. Even if you have not stayed in that country wherever you are staying for 183 days, because UAE also has a DTAA, wherein they have mentioned that if you want to become a UAE resident as per India UAE DTAA, you need to stay in UAE for 183 days or more. Correct. So what I'm saying is that first we are checking that whether we will become non-resident in India or not. So to become non-resident, you need to stay in India less than 183 days. So let's say, for example, you are going out for employment to UAE. Correct. Now your joining is from December. Correct. But you said that okay, I'll join from December, but before that I need to explore the place, because I need to see where I'll be living and what all place I need to stay and everything. So you move out from India, let's say from September, because you have planned a vacation also for 1 month to just roam around and everything. So in that case, what you can do is that you can still say that I was moving out of India for the purpose of employment. And since I moved out of India in September itself, I've stayed in India for less than 183 days. And accordingly, my taxability, and I will be a non-resident in India for the purpose of taxation. Correct. Even if you have not stayed in UAE. So let's say, for example, you have not stayed in UAE, so you will not be a tax resident of UAE. So in that case, you might not be eligible for India UAE DTAA, but still you will be a non-resident for India. Moving on to the next slide. Yeah, now coming on to the specific nature of income that we have discussed. Maybe Ayush, your also some of the points will get covered in this coming up 3-4 slides. Now discussing about dividends that one earns from India. Now discussing about dividends, what it generally says is that it is India UAE DTAA. So it speaks about any income which is derived by any person or any similar rights in the profit of a company. Correct? That is considered as a dividend in simple words. Now, reading that provisions of India-UAE DTAA, what it shows is that such dividend will only cover dividend from a share. Now, again, a question comes that whether mutual fund dividend will be covered or not. Now, when we see mutual fund dividends, correct, it is, we'll discuss the case. Someone has written in the chat about the mutual fund case law also. We'll discuss that, and from that we can derive a conclusion for dividend as well. Because in that case law also, what they have bifurcated is between a share and a mutual fund. Yes, the share and a mutual fund are two distinct securities or two distinct type of instruments in which you can invest, and that they have bifurcated. So in the judgment, they have mentioned that share is a different type of instrument and mutual fund is a different instrument. Similarly, in this dividend, India-UAE DTAA also, the share here what they have covered is the shares, correct? So they have not covered mutual funds. So in our understanding, any dividend that you earn from mutual funds as of now will not be taxed as per India-UAE DTAA in India. It will be taxed in your resident country only. But again, whatever we will be discussing with regard to the India-UAE DTAA, that could be subject to litigations. You need to take your stand whenever you are filing your returns. Please consult your respective tax consultants, because this is something which is based on interpretation again. Law is something which is based on interpretation. So we need to be very sure when we are taking a position as per India-UAE DTAA that whether we are ready for that risk or we are 100% convinced whether this will be taxed in India or not. Now, as per India Income Tax Act, such dividend is taxed at 20%. But if you go to India-UAE DTAA, the rate has been restricted to 10%. Correct? So again, you are saving 10% tax by taking the benefit of India-UAE DTAA. Correct? Now moving on to the next slide. Interest income as per India-UAE DTAA. Now again, this is the second type of passive income which many people earn from India, which is interest. Maybe it could be from NRO interest, it could be NRE interest, it could be interest from maybe your relatives to whom you have given some loan, etc., etc. Correct? So now when we discuss about the interest income, as per Income Tax Act, it is taxable in India. However, as per India-UAE DTAA, there are restrictions on such interest income, wherein the income includes income from government securities, from bonds, debentures, correct, and such other deposits. So correct, there is the definition of interest speaks about interest from debt claims or interest from loan provided. Now in this case, we can say that interest from NRO is one kind of debt that we have given to the bank. So if we look at from the perspective of bank, it could be a debt for them. But as far as the interpretation goes, someone could say that okay, these are deposits and these are not debts, so this could not be covered under the interest definition of India-UAE DTAA. Correct? So again, in interest, there is a very high situation that the NRO deposit interest might not get covered in the India-UAE DTAA, but still there is a position which one can take because this could be considered as a debt to the bank. And accordingly, as per India Income Tax Act, there is a tax rate of 20% on interest, whereas as per India-UAE DTAA, there is a tax rate restriction of 12.5%. Correct? So that is how you can even save tax on that. So on some kind of interest, there is 20% rate. On some kind of interest, there is 5% rate in India Income Tax Act. On some kind of interest, there is even a slab rate that is applicable. So we need to check under which provisions are we falling, and if we are falling in the slab rates, and if our slab rate is not, because currently the slab rates have changed a lot in the India law, because till 24 lakhs there is no 30% of tax, after 24 lakh there is a 30% tax, correct, from this financial year 25-26. So again we need to check under which slab rate are we falling, and once we have determined that under which slab rate we are falling, then we can see which one is beneficial, and the non-resident will always be at a liberty where they can check whether they are whether the Income Tax Act is beneficial for them or whether the DTAA. Now moving on to the next slide. Now this is something important. I believe everyone would be waiting for this capital gain, that how capital gain will work for us when we are dealing in shares, securities, mutual funds, correct? So now we have tried to cover it in three of our boxes: immovable property, sale of shares, and other properties. Correct? So immovable property. So immovable property is generally taxed at least in the state. Now, when I talk about state, it will be considered as a country, correct? Because there is a DTAA between two states, which are two countries. So immovable property is generally getting taxed in a country where it is normally situated. So if you're a UAE resident having any immovable property of your ancestors in India, and if you sell that, it will be 100% taxed in India. Correct. So if you are having any capital gain that you will be having in India, you can surely claim exemptions under section 54, 54F or any such other provisions. But if you are not able to claim them, or the investment is not sufficient to cater the capital gain, you will have to pay some tax in India. And you don't have any tax, I believe, in UAE. So you don't have to take any double tax, or you don't have to pay any double tax. It will be only taxed in India. Now moving on to the shares. Again, shares will be taxed in both the countries, in the resident country as well as in the source country. So similarly, in case of shares, you will have to pay some tax in India, the 12.5% on long-term gain, the 20% on the short-term gain listed shares. So that all types of tax you need to pay. Correct. That will be paid in India. And if in future there is any tax in, let's say, UAE or Qatar, then you might have to pay it there as well. Now coming to the other properties, correct, wherein they have mentioned that if the UAE resident sells any other type of property not mentioned above, the gain is taxable only in the country where the seller is a resident. Now this is important. Now the case law which we were also discussing, there was a recent judgment which everyone which caught the attention of each and every person, that mutual funds is not to be taxed in India for non-residents. These were the headlines of many newspapers, that mutual funds will not be taxed in India for non-residents. Correct, but that is not the whole truth. Again, as I have discussed earlier, that newspaper gives some headlines, but that might not be the whole truth. So now we need to understand that how mutual funds is not taxable in India for various kinds of non-resident. Now, if we go back to the previous slide, therein there was a capital gain on shares. Now the judgment which we are talking about, moving on to the next slide, the judgment talks about, this is a judgment specifically for UAE, correct? Delhi Tribunal, which is a specific judgment for UAE, and the judgment which came into picture was specifically for Singapore, I believe. But that was a later judgment. This was the first judgment which was there in relation to the UAE DTAA, wherein they have clearly mentioned that the DTAA specifically talks about shares. Now, when they are bifurcated between a shares and mutual funds from the perspective of SEBI guidelines. Now, SEBI bifurcates between a share and a mutual fund. Correct. So, when the DTAA specifically talks about shares, and it says that shares can be taxable in the source country, that is India. Correct. So, that's why they have mentioned that the other mutual funds will not fall under the category of shares, and it won't be taxable in India. It will fall under the residuary category, wherein it is said that such type of capital gain will only be taxable in the resident country, that is UAE as of now. Correct. So that's why it was covered that, okay, if your DTAA covers such a provision wherein it is mentioned that in case of any other capital gain, and if mutual fund is not getting covered in any of the above provisions, mutual funds will be taxed in the resident country. Correct. It is not a blanket rule that for any kind of non-resident mutual funds will not be taxable in India. Correct. It is the specific DTAA that we need to check every time when we are dealing with such cases, whether the mutual funds will be taxable in India or not as per DTAA. So this was the case wherein it was discussed for UAE that any mutual funds gain that is earned from India will not be taxable in India, but will be taxable in UAE. So I hope this is a big question that was there, that we have got earlier also on our social medias and everywhere, that why mutual fund will not get taxed. Is it a blanket rule? Is it available to all? So I believe that will be more or less question. Moving on to the next slide. Now, this is a summary that we have tried to prepare for any that income that we have discussed currently, correct? This is not an exhaustive thing. We are currently here to discuss about your queries and everything. So this is just to give you a glimpse on how taxation would work on your various types of income. If you will maybe discuss this at length if we are on a one-to-one consultation on your specific cases. But as of now, this is a general thing that we are trying to present before you, so that at least you are aware on what type of income will attract what type of taxation. Correct. Moving on.
Yeah. So
Yeah, Ankur.
So I just wanted to take a pause here. We have
Okay.
covered like what are the benefits available under the India UAE DTA,
Correct.
and we can maybe take some questions just related to this. I know some of
Correct.
your questions around how to avail of these benefits, so that we will be covering in the next section.
Yes.
But if anyone has any quick questions, we can take 2-3 of those questions around what kind of benefits are available. Some of them we have already answered in chat, but we can
Okay.
take a pause for a couple of questions.
Yeah.
Yeah,
Hi.
I have a question regarding the interest and dividend income. Like with regard to capital gain, we have a strong case law that has been passed
Correct.
recently, which supports our case if we are going to take the benefit from gain from mutual fund.
Correct.
But for interest and dividend, we don't have any case
No.
laws right now.
No.
So is it worth it to take the risk and come in the eyes of income tax department, because everybody has some type of plus minus in their books? Okay.
Correct.
Maybe I am a salaried employee, but even if we try to take some advantages which are in the
Correct.
gray area.
Hmm.
So what is your opinion on it? Like, is it worth it to take exemption?
Yeah, so if you ask me for my personal opinion, correct? So now looking at the case law again, you have mentioned that it is a very strong case law that we have for mutual funds. But in my experience, when I see that there was already a case law for UAE, but still there was a case that was reopened by the assessing officer for Singapore country, correct? Because even though the DTAA was same in both the countries, but still the officers will try to take up the cases, correct? Because we need to understand that we see that okay, there is a strong judgment and there will be no capital gain tax that will be taxed in India, but we need to understand that that case has also traveled from the lower authority still income tax appellate tribunal, and then also there were some judgments against them. So then when we are taking any of these benefits, we need to see that what is the quantum that we are trying to save. If we are saying that okay, let's say for example, if I am earning some, let's say 1 lakh rupees of interest, correct, and if I'm going to pay, let's say 20,000 or 25,000 worth of tax on it, correct, and then we are taking a position wherein we say that we'll take the DDAA benefit and we will try to pay some less tax, and now that difference is, let's say, only 10,000, 15 or 20,000, and if you go for a litigation, the litigation cost will only go up to 50,000, 70,000. Then there will be no cost benefit analysis. So you have to do your cost benefit analysis based on your quantum that is involved. Let's say for example, if a person is earning, let's say 1 CR of dividends from India from mutual funds, and if he says that okay, I have a dividend income of 1 CR and I want to save it, I want to restrict it to, let's say, 10%. Currently I'm paying 20%, which is 20 lakhs of tax. I want to save and I will restrict it to 10 lakhs of tax. So in that case it becomes beneficial because you are still saving 10 lakhs worth of tax. Even if you go into litigation, it won't go about 1 lakh or 2 lakh of cost. It will still remain a very minimum amount. Correct. So in that case, you are still having 90% benefit. You are still saving 90% of your cost. Correct. So that's how you need to check whether there is a cost benefit analysis for you or not.
Yeah. I
Summarize.
understand. Thank you. Thank you.
Yeah, I think to summarize, and based on my discussions that I've had with Naman also, it is like, I think mentally you have to be prepared that it will be
Yes.
disputed. Now,
Yes.
based on that, you should take a call whether it's worth it for you or not. Because obviously, like Indian tax authorities also, will not want to lose any, source of revenue.
Correct.
So
Correct.
assume that it will be disputed, and then based on that, you can take that call.
Yes.
And with regard to the mutual fund capital gain, do you think like it will be put under litigation again?
No, so considering there are two different tribunals which have given the similar view. So this was a Delhi tribunal and the Singapore one was a Mumbai tribunal as far as I remember. So if two tribunals have given a similar view, and these are the two major tribunals in India because majority of the non-resident cases go to either Delhi or Mumbai, or third one could be Bangalore. Correct. So these are the big tribunals which have given a judgment, and there is no question or gray area. Whatever they have discussed, and they have discussed the cases on a similar lines. So I don't think there will be any further negative impact, or there won't be any high court decision on this anytime soon. But still, the lower authorities will try to challenge it because they will say that okay, no, this will be taxable in India, and shares includes any types of securities. So from lower authorities, there could be a question, but as soon as you move high, or maybe at least at CIT appeals level, which is the second level of litigation, you might get some benefit of those tribunal case laws.
Okay,
Hi,
thank you, ma'am.
Yeah.
Thank you so much.
Yeah.
Hi, Namal. Hi, Ankur.
Yeah.
Jagdeep here. So I'm currently working in Nigeria. So wanted to just check on few things.
Okay.
Let's say we have here generally we don't have a TIN number.
Okay.
Typically, which have started very lately now, but typically there are different states which has pay number for each of the
Okay.
state. There is no centralized TIN number earlier.
Okay.
Now they have started. So the company generally pays tax on our behalf, and that is, because African countries, most of the countries operate in this fashion, wherein
Correct.
they do not show the entire income. There is a local allowance or local part of the salary which they pay taxes on to the
Correct.
national government, and the remaining
Correct.
comes to the NRI account directly from
Correct.
Dubai, from a Dubai entity or a Singapore entity like that.
Okay.
So in that case, uh, is there any chance, because we are non-resident, for example, we are staying more than 183 days outside the country, but is there a chance that the income which is not being taxed on in Nigeria will be questioned in India? Number one. Number two, now they have introduced a TIN number, which is company has not yet applied for, because that is not yet a mandatory. But some of the banks are asking for the FATCA,
Correct.
compliance as well as the
Yes.
KYC and all. So we have
Yes.
obtained that, though the taxes are not being paid against that TIN number, because they are paying in different states basis the pay number of that state.
Okay.
So what do you think will be the implication on providing this TIN number to the banks and while filing as a non-resident? Just wanted to get your
Okay.
thoughts.
Surprisingly, I had done a case for one of my clients who was also returning from Nigeria. It was a similar case of Nigeria, wherein he was telling me that the company has to pay some 5% of tax to the government directly, and and they get the money after the tax deduction and everything, and they don't have to take care of any of the tax filing or anything like we do in India. Correct. So in that case also, he wanted to, since I think there is someone on. Yeah. In that case also, what was the issue, that he was returning to India, so his global income was getting taxed. Now he was saying that we had already paid some tax in Nigeria. Maybe my employer has paid on my behalf, but that is from my salary. Correct. So in that case, I want to claim benefit of that tax that has been paid on my behalf. So we had requested him that to get a letter from the company that they have paid so and so amount of tax and a proof that tax was paid on his behalf, a challan or something. So he provided us that, we claimed the benefit of that, and he got the credit from the income tax department regarding that. Correct. So it is always that you need to get some proofs that that your employer has either paid tax on your behalf, and some sort of government proof that the tax was deposited to that government. Correct. So if you are able to get that, you can still get a claim in India. And if you have a proof that you were employed outside India and you are a non-resident, then in that case your salary income cannot be taxed till the time you are a
No,
non-resident.
we are a non-resident. We are
Yes.
a non-resident, as we
Yes.
have work visa in Nigeria, everything is
Yes.
there. What I'm
Yes.
trying to ask, let's say I am staying in Nigeria more than 183 days. So I am a
Correct.
non-resident of India and I'm a tax
Correct.
resident of Nigeria.
Yes.
Okay. In that case, but the government, let's say someone is earning 5 lakhs a month, right? The tax in India would be, let's say, 35%, there about
Correct.
one and
Correct.
a half lakh a month.
Yes.
But here the government is paying, here the company is paying with some setting to the authorities, they're paying maybe
Okay.
10,000 rupees a month,
Correct.
right? So,
Correct.
and that is against different state has different pay numbers.
Yes.
It's not centralized. So,
Yes.
and that proof is not given by the company to the employee. While
Okay.
filing tax in India, my salary part 5 lakh, let's say 50,000 I'm getting here, and for 4.5 lakh I'm getting in my NRI account directly from a Dubai entity of the same entity of this same company. They have a Dubai entity. From there, they're disbursing the salary. So
Okay.
in that case, how does your like complications of tax filing, though you are not a resident and you don't file the tax in India, you just you declare whatever is the Indian income. But do you get any future complications because of this modality? Because that is
Jagdeep,
what the companies are
sorry
doing.
to interrupt. Can I just request you that we'll take this offline, because this is a off topic from
Sure,
India-UAE DTAA, and we're already running short of time. So
sure,
we
sure,
can definitely get back to you. If you can just write down your query to us, we'll definitely get it answered from Naman.
sure.
Thank you. Thank you very much. So yeah, we'll proceed. I
Yeah.
think
Yeah.
a lot of
Proceed.
questions coming in on
Yes.
TRC
Now again,
to avail the benefit.
So now the important question, how to avail the benefit of DTAA. Correct. These are the some list of documents that we have mentioned. That is the TRC of from the country of residence. Form 10F, which you need to file in the income tax portal of India. Now there is no offline submission of 10F. It needs to be done online. And everyone who is trying to avail benefit of 10F, they need to file DTAA. They need to file Form 10F on the income tax portal. Correct. Next would be your TIN number, correct? If any of your countries don't have a TIN number, you can still mention the passport number, your passport number in case in alternate to the TIN number. So these are some documents that you need to have for taking the benefit of DTAA. Now again, many questions come that okay, my country don't have a taxation system, so how will I get a tax residency certificate? But that is not the case. Even in UAE, Qatar, everywhere they issue a tax residency certificate, wherein we need to first understand that each of these countries have the power to tax you, but they are still refraining to tax you because they are having other sources of revenue, correct? So it is not a case that they don't have the power to tax you. They have the power to tax you. They will issue you a tax residency certificate, which will be in the prescribed format, and it will be specific to a country for which you wish to apply and to avail a benefit of DTAA. Moving on. Now, what is a tax residency certificate? Tax residency certificate is a specific certificate issued by the government of a state where you stay, and it gives you a tax residency certificate for a second country with which it had entered into a DTAA, wherein they mention that as per this DTAA, Double Tax Avoidance Agreement, you are a tax resident of their country, and they also mention that for which period they are providing that certificate, and for which date they are providing, and your name, your address, everything will be mentioned in that tax residency certificate. So you need to go to your government and apply for a tax residency certificate. In the coming slides, moving on to the next slide, maybe we will discuss that how you can apply for a UAE tax residency certificate. Again, this is from a UAE side. So I am not a UAE tax expert, but this is what I have tried to get from the official website of UAE government. Maybe Ankur and his team can help you to get some TRC from the UAE side, because they have some experts there who can help you to get a TRC. But this is just a brief understanding on how you can maybe get a TRC. So eligibility means you need to be primarily reside in UAE. You need to have a physical presence condition in UAE. Further, what documents would be required? Your passport copy, UAE residence visa, Emirates ID, proof of residence, immigration report, latest salary certificate from UAE, and UAE bank statements of last 6 months. Next. Now, how to apply? So first you need to check whether you have been in UAE for 183 days or not in that particular year for which you are applying. Again, you need to check that what kind of year is followed in UAE. So it is a calendar year which is followed in UAE. In India, it is a financial year, April to March. In UAE, it is January to December, and many of the foreign countries other than India are following that calendar year. So first we need to check that what period are we applying for. Next, gather the required documents that we had discussed earlier. Apply online with a Federal Tax Authority portal, wherein you can apply for a tax residency certificate, and it is the fees ranges anywhere between 1200 dirhams to 2000 dirhams, anywhere between that. That will be the actual fees that the professional might charge, and within a week or two you will get your tax residency certificate for that year. Correct. So again, now since 2025 has just started, you might not get it for 2025, but if you are in UAE for the previous year 2024, you can just get for that. Next.
So Namal, sorry to
Yes.
interrupt, and I think
Yes.
someone had this question super quick. So
Yes.
would this calendar year TRC hold
Hmm.
valid for the financial year TRC tax filing for the next year?
Okay. Now, if we see, so let's for example, you have a TRC of 2024, and currently we will be filing income tax return for 24-25. So for 9 months, you will have a tax residency certificate, which you can use 2024 certificate for those 9 months. And for 3 months, what we can do is that we can give a self-declaration that I have been in UAE for the next 3 months also, and we need to be in the process of applying, because let's say for example, now in June you will complete your 183 days in UAE, correct, in June itself.
Yeah.
So after that, maybe you can apply for a 2025 TRC also and get a TRC for 2025, and later on if there is any question from the income tax department, maybe you can submit that. So currently what we do in case of various foreign companies as well, based on previous year's TRC, we take a benefit for this year as well, because it takes time because of the difference in timing between the two countries. So at least if we have TRC for previous 2-3 years, we can just rely on that and take a benefit based on that information.
Wonderful. That's a great input. Thank you.
Yes.
But this 1200 dirham, you need to pay every year, is it?
Yeah, this will be for, so again, TRC, residency, everything is a year-wise thing. So you need to check every year, and you need to pay this fees every year if you want to have a TRC every year.
Okay.
Yes. Next. Now, what is Form 10F? Again, there is a question that if I already have a TRC, tax residency certificate, why do I need to have a Form 10F? So there are various requirements as per different countries' local laws. So this is a requirement as per the local law of India, wherein they mention that okay, there could be a situation wherein you are providing maybe a TRC is in, let's say, different language. So let's say in case of China, there is some different language and not in English, the TRC. In case of UAE, it is in English, but it won't have some information. Let's say, for example, the India provision, that is Rule 21AB, that asks for your status, that your address in the TRC, but Dubai does not provide the address in the TRC. So in that case, it is advisable to file Form 10F, because Form 10F asks you for very specific information which they need as per their law: your name, your status, your address, your communication details, everything. Correct. So based on that, they ask you to file Form 10F, and while filing Form 10F, the important document that you need to attach with it is tax residency certificate. So once you attach that tax residency certificate with the Form 10F, you will be eligible to claim the benefit of DTAA while filing your return of income. Again, please note that even if your TRC contains all the information which is required as per the Indian rules, what we have practically seen is that if you don't file Form 10F, the income tax department, while processing your income tax return, won't give you the benefit of DTAA. So it is advisable, irrespective of whether you have a TRC or not, or sorry, whether your TRC contains all the information or not, you should file Form 10F before filing your return of income, and it could be filed with a OTP. As you file your return of income, you can file it with an OTP. Correct. Moving on. This is how a 10F would look when you file for the Form 10F. This is how you are generated. This is the final result which will appear on your. So again, it's not something that you need to go and get an approval of. It is a self-declaration where you are providing the information to the government. So you just need to submit it and Form 10F will be generated. So if any of you are trying to take benefit of DTAA with any of the Indian companies also, you need to submit your TRC and Form 10F to them, and only then you can claim the benefit of DTAA. Next. How to claim exemption? We have discussed. You need to, while filing your return of income, you have to disclose your returns in specific heads, other sources, capital gain, whatever. But for claiming the benefit of DTAA, there is a schedule TR, which is for tax relief, wherein you need to mention that for which country are you claiming the DTAA benefit, then the section or article of the DTAA for which you are claiming the benefit. Let's say, for example, you are saying that you want to save capital gains on mutual funds. So you will select Article 13. Then you need to mention the nature of income. So in our example, it will be capital gain. Then the tax paid outside India, that will be zero. Tax relief claimed, that is the Indian income tax for which you are claiming the relief, and method of relief will be exemption. So this is how you will normally claim a tax relief while filing your return of income for DTAA. Again, if you are filing on different softwares, for different softwares, it could be a different place while you will be where you will be mentioning these details. But the important information is that you need to mention 2 or 3 important details. That is the country for which you are a resident, the amount of income which you want to claim as exempt because of the DTAA, and the article in relation to which you are claiming this benefit. So this is how the information will be mentioned in your income tax return. Next. Schedule AL. This is again a very important schedule which many a times some of the non-residents forget because they are not a regular filer in India or they don't have regular income in India. And this is also a very, let's say, a very rare scenario wherein a non-resident would be required to file a Schedule AL. But this schedule is required if you have a total income of more than 50 lakhs in India. Correct. Then in that case, if it could be a situation where you are having a capital gain from shares, mutual funds, immovable property, and your income exceeds 50 lakhs during the year. So in that case, you need to mention the details of your all the assets and liabilities in India. Correct. Please note that in case of a non-resident or a not ordinary resident, you need to always mention the details of all the assets and liabilities only in India. You don't have to mention any assets or liabilities of your foreign, because many a time they say that, okay, do I have to disclose my shares that I have in UAE or the house that I have in UAE? No, you need to only mention the assets and liabilities which are in India. Correct. And in case of RNOR as well, it will be only only Indian assets which you need to disclose. Again, RNOR is also getting a bit complicated. Earlier, it used to be very simple because people used to stay outside India for a longer period. But with the new generations and the new employment situations, many a times people tend to move from UAE to India within 2 years, 3 years, and at that time it becomes very important for you to check whether you are a not ordinary resident or an ordinary resident. Correct. So that is also which you need to take care of. So I believe with this we have covered most of the things that we had to cover in this seminar. We'll just maybe is there any next slide? I believe that we have covered everything. Yeah, so we have mostly covered everything. Maybe Ankur, you can discuss something important in here with regard to the taxation and everything.
Yeah. No, thanks, Naman. Yeah, I think we can go to the next slide. So one announcement that we wanted to make is that we have, we have empaneled NRI tax experts like Naman, who have agreed to help us with the tax filing requirements of NRIs, including in the UAE. So this is something that we are starting today. So you can head to the website. This will be I think this is available now on the website, and we'll take care of the end-to-end filing. We have kept it, very economical. Generally, in our conversations with NRIs, we have heard this complaint that there seems to be, some NRI markup that just because you're an NRI, you get charged more. So with, Naman and other tax experts, we have worked hard to eliminate that and come up with a very fair and transparent pricing. So do check it out if for this year you are looking for someone to take care of your tax filing. We can just there are some questions. Yeah, so you can scan this code. It should take you directly to the website. And while some of you might be checking that out, let us quickly take the questions that people have put in the chat, and then I will open the floor to some other people. So I'll just take it one by one. I think Neeraj has an interesting question. I also had this in mind that now, with this, see, the DTA has been in place since 93, right?
Correct.
So it has been there for a long time. But now with all this attention going to it, especially around capital gains, exemption for mutual funds, like what do you think? Like, will this be done away with now? Has the countdown started? Is it a narrow window? Like, what has been your experience? You must have seen these with other DTAs or in general other
Yes. No, so when we talk about a double tax avoidance agreement, correct, we need to understand that it is not a local law of India that they can just change overnight, correct? So there could be a loophole in the India law which they can maybe change in the next next budget or any finance bill, correct? But this is a agreement between two countries, correct, which cannot be just finished overnight or changed overnight. Again, we need to understand that double tax avoidance agreement are entered based on the mutual understanding of two countries. Correct. There is a case where even fees for technical services not taxed as per the India-UAE DTAA. So there are some cases which they might have left intentionally to not tax. Correct. So this is not a loophole that we can say, but that this is a strategic move that they might have taken to not tax mutual funds. Correct. So I don't think it will get maybe covered in the next 1-2 years. But if there is a substantial amount of tax that they might think that we are losing because of this, then there could be a change in. But again, the UAE government also needs to agree to implement this change, because it is not a one-way communication. The agreement needs to be agreed by both the parties.
No, I think, yeah, that's a very important point. Even I had not considered it from that perspective, that both of them will have to agree. And yeah, we should keep in mind that it's not like they forgot to cover it.
Yes.
It has been left out intentionally. Maybe they want to
Yes.
attract investments into
Yes.
India, because obviously NRIs are a important
Yes.
source of foreign currency,
Correct.
which we need of. So yeah, so that's good news. It's probably here to stay for
Yes.
a while. Manish also has a interesting practical question, and if my interpretation is correct, so he's asking, let's say, there's an outstanding capital gains of a few crores, right? So which he has not booked yet. So is it advisable to book everything in one go and claim the exemption in 1 year, or should he spread it out? Like, is there any advantage?
No.
Yes.
Yeah, so practically speaking, so you might be thinking that okay, अगर मेरा amount छोटा होगा तो शायद income tax के ध्यान में वो नहीं आएगा. So maybe that is your thought process, that if the amount would be a bit a little less, then I might not be I might not be covered in the radar or the thresholds of the government. So that could be a thought process. There is no hard and fast laws or the rules which has been defined by the income tax, that okay, this amount will be covered, this amount will not be covered. So you can definitely spread it over 2 or 3 years. But again, if you are doing it for 1 year and you are doing it for every year, they still have the powers to open case for 10 years, correct? So if it gets caught, they can cover it for all the years. But yeah, the thought process might be correct, so that you are reducing the quantum for each year. That could be a thing that you can think of. That could be a thought process. But yeah, there is no hard and fast rule that can be implemented.
Yeah,
So
and again, if
Namal,
I
thanks for that. If I may chime in into Manish's question, I had a similar
Yes.
question. I think
Yes.
not from a perspective of getting the watchdog over you, but maybe from a
Okay.
perspective of objectively, would there be a saving if you spread out your gains over a few years? Because there are few exemptions on the capital gains. So
Correct.
financially, is that better or not really?
No, but if we are talking about, his question is specifically for mutual funds, correct? If we talk
Yes.
about mutual funds, it is completely exempt in the India-UAE DAA. So correct. So there won't be any exemptions which will any ways affect your decision as far as mutual funds are concerned. So I believe then
there's no
in that,
limit or cap to it. So,
correct.
and if you spread it out or not, at least from a quantum of benefit that you are
Yes.
eligible to, there will not be any difference.
Yes.
Okay.
Yeah,
The
and if I
quantum which
pair
is,
it
So,
with
yes.
what Naman was saying earlier, that recently there have been a couple of judgments, and it's
Yeah.
less likely to be questioned now. So maybe another way to think about it, that right now they may not challenge it, so might be better to do it.
Behti Ganga mein haath dholo.
Yeah.
Correct.
Correct. Fair enough. Thank you.
Got it. And yeah, one more question I missed earlier. It's an interesting one. How does ETF get treated? Is it closer to shares? I mean, it's not obviously covered in the DTAA, so open to
Correct.
interpretation since we don't have any case also. But is
Correct.
it closer to shares or is it closer to mutual funds?
No, so if since it is also not a, so again what they have covered is a share of a company. Now when we go, it is again a kind, I will rate it similar to a mutual fund, because it is any which ways an investment fund. It is
That's
not
true.
exactly a stock. You are not having an ownership in a company, correct?
Yeah.
In a pool of money, you are also investing some of your money, just like a mutual fund. Correct. The only difference is that in that case, it gets distributed in various companies. In mutual funds, in exchange traded funds, it gets distributed in some nifties or anything, something like that. Correct. So, in my understanding, it is still not a very similar kind of thing to a share. It could be in the similar fashion as a mutual fund. In my
Got it.
limited understanding, we might have to wait for some judgments, but as of now, it is still not a share of a company.
Got it. Got it. Anupam has a question, that is it advisable to apply for TRC only when someone plans to, redeem mutual fund? I guess it means like only when someone plans to take
Yes.
benefits under DTAA. So you should do it only one, or should one just do it as a matter of good practice? Like, does that help to have that history?
No, so having a TRC always gives you a benefit that you were a tax resident of that country for at least that year. So even if let's say someone was asking me a question that if my country is not having any taxation, so can the Indian government charge me tax on that amount? So in that case, having a TRC can definitely help you, saying that okay, I am a tax resident of XYZ country, and in that case, you cannot tax my income that I have earned in that country. So from that perspective, it can be helpful. But as far as getting benefit is concerned, I think you can very well go for the year only in which you are having a benefit, because it is not a very small fees that you have to pay to get a TRC every year. So maybe you can plan accordingly.
Got it. Got it. I think, yeah, those are
One
most of
thing
the
just
questions. I think
wanted to
Gurab's
ask
question
regarding
also
this
has been
filing
answered.
of taxes is
Yes.
people from Nigeria also can apply for this uh, through this facility you are providing, or is it only for the UAE residents?
No.
Yeah, sorry, Jagdeep, can you repeat your
Say, I
question?
wanted to check this your providing the service of filing the income taxes
Okay.
for NRIs. So is it for applicable for Nigerian tax residents as well?
Naman, what do you say? Because he is the one who is going to help us.
Yeah, we
Naman,
cover all
over to
types
you.
of non-residents. That's not an issue.
Sure. Thank you.
Yes.
Cool. I think there's one more question. I haven't filed my ITR for the past 5 years. Is it still possible to file returns for those years now?
No, so there is a policy in India of updated return wherein you can file returns for last 4 years. But again, that is only available if you have any tax liability in those years. If you don't have any tax liabilities, you are not required to file return of income. No one will question you. But if you think you have any tax liability, you can file for last 4 years.
Got it. And okay, if I file, so there are a couple of more questions on chat. I'm just taking them one by one. If I
Okay.
file the ITR, will any losses from previous years be considered for tax purposes and carried forward?
No. So as I have mentioned earlier, why is it important to file return of income every year is to claim those losses. If you haven't filed returns of income for your previous years, you cannot now claim those earlier year losses and carry it forward to future. That cannot be done.
Got it. TDS has been deducted on all my income. Will that be adjusted in my ITR filing and reflected as a benefit? Yeah, I think the answer is yes.
100%. Yes.
Obviously, we have to
Yes.
put it in the right places. I mean, obviously,
Yes.
there is a lot of data that gets auto-filled, so we just have to make sure that the entire data is correct. But yeah, that
Yes.
is available. Another one is I recently booked a profit in stocks and reinvested the same amount. Will that profit still be taxable even though it was reinvested? Yeah, the answer is yes. I mean, your reinvestment does not change the
Yes.
taxability of the gains that you had while selling. Okay, we have some more. ETF, yeah, I think ETFs we have covered.
Maybe if someone have any question, they can raise hand. If
Yeah, please go ahead. Unmute yourself.
So
Anupam, do
put
you?
down a very specific question in the chat. Conscious it's a specific question, we can cover that one-on-one as well. If you feel it's something that the group will help, feel free to address.
Yeah, I think we can. Let me just take the other questions, Himanshu.
yes, if we get
There is
time
some
in
time,
that. Yeah.
right? So yeah, I think Manish is asking if someone is selling mutual fund and book profits and buying back again in 2-3 days just to remain invested. Is it a bad practice for DTA? Okay, I think I get the question. Like, will it be looked down upon that this has been just been done for tax harvesting or something like that? Or
Yeah,
is it
I
a
think
legit thing to do? Like it
Yeah,
doesn't.
so as you have already mentioned the term tax harvesting, so many people do it in India as well. It is not just about non-residents. Many residents also do it. It is a tax harvesting, the tax harvesting, which is a legal term, wherein you are just booking your profits or losses and managing your taxes. Correct. So it is nothing illegal in that. It is a very well accepted practice. But the only thing is that you are doing it legally. There is no other means by which you are doing it. So it should be very much legal, then it's allowed.
Got it. Yeah, Priya has another, I think, pertinent question that NRIs are getting reminders for tax filing when there is minimal to no income. So can it be safely ignored? Like, is this a general reminder being sent, or
Yes.
these are specific to that person?
No, it is a general reminder. If you even read the mail, it says that you can ignore if you have or if you don't have any income. So it is a general reminder, but yeah, it's a good reminder. You can always go and check your AIS and TIS annual information statement, wherein all the information that the government has for your income, you can go and check. And if there is anything incorrect, you can maybe report it as well. So it is a good practice from the government that they are reminding to all the people to file the return. So please go and check your AIS and TIS regularly for every year so that you are aware that what information is available with government.
Yeah, Anupam was wondering if we provide services for TRC in UAE. Yes. So yeah, Anupam, we can help you with it. That's not a problem. Where can we check AIS and TIS? So these are available on your
Income tax portal.
income tax portal login. Now they have app also. I mean, sometimes it works, sometimes it doesn't. But you
It's
can.
better to go to the website. Website
Yeah.
works no, more or less smoothly. So you can go and log into your income tax portal of India, and then there will be a tab specifically for AIS. Please go and check for the respective financial year.
Yeah,
Right.
I
Thank
think
you.
have the latest data been updated? Last time I checked, last quarter was not updated.
So
You have?
so last quarter was due date was 31st May to file the data for last quarter. So this is nothing but the data that they collect from different types
Yeah.
of aggregators, maybe mutual fund houses or someone like that. Correct. So the last date was 31st May. So it might take 2-3 days more to collect all the data, but you can check, it gets updated in real time. So you can check regularly if it is getting updated.
Got it. Got it. Yeah, another question from Priya. When a UAE resident is moving back to India, is it recommended to sell everything and reinvest from resident account to make max use of the benefit? So here, I mean, obviously it will depend on, what exactly you're trying to do. But just one thing for you to be aware of, Priya, is the whole RNOR status, right? Like if you have been in UAE for long and you are returning back to India, there is generally a window in which you will qualify as RNOR, resident but not ordinarily resident, in which your global income is still not taxable in India. So there are some benefits to it. In fact, we had co-authored an article on Mint on this RNOR thing. Maybe we can share that on chat here, that link, or we have shared it in our community also. So yeah, that is something to keep in mind. And also in general, I'll let Naman also chime in. But in
Yes.
general, I think tax should be considered as one aspect of the entire planning and not the entire reason for doing this. So do keep that in mind as well. Yeah, Naman, you want to add anything to this?
No, just the thing that when you are moving back to India, it is always advisable that many a times people think that, okay, I need to open a company when I move back to India in UAE or US or something. So always before getting back to India, always consult a tax consultant in India. You can consult us as well. That's not an issue, but you should always consult anyone before that. And if there are any things that you can plan out by selling, as you were saying, or by maybe forming a company outside India, you can very well do it before coming to India. It's more beneficial to do it when you're outside India to save yourself from FEMA or any other laws which are applicable on non-residents.
Awesome. I think yeah, we can take Himanshu's question. Others also feel free to put down their questions or unmute.
Yeah.
So Himanshu's question is, or Himanshu, if you are there, would you want to ask that?
Sure. I think it's around taxation for joint accounts.
Okay.
So I've been investing in India for a fair bit over the last, say, 5 or 7 years, specifically from the joint account. My wife has never filed ITR, but I've been filing ITR on both the gains that I've had on my personal account and the joint accounts as well.
Okay.
So now I've started investing from her account as well. So essentially,
Okay.
she is investing now, and
Okay.
she would have gains on her account starting now. So is it a good idea to like start filing RTR now after say around 10 years of not filing it?
Yeah, it's always a good practice to start filing a return of income. And again, as far as joint account is concerned, maybe like other countries like US and everywhere where there is a joint filing for husband and wife, in India is a separate filing for all of them. Each individual is filing returns for themselves. So again, when we are investing from a joint account, it is very important to check whether you are who is the primary holder and who is investing money in that joint account. Because in India there is a provision of clubbing of income in case of husband and wife, wherein if one of the spouse is transferring any funds to the other person without any consideration, and if that other person is earning any income out of that, it will still be clubbed in the income of the person who has gifted it. Correct. So it is advisable to also check those provisions and take care of that while shifting any income or shifting any amount to the spouse.
I see. Okay. Thank you.
Yeah.
Okay, yeah, I think we are done. I think we have also exceeded the time. So thanks a lot, Naman, for patiently answering all our questions. And yeah, as we said, we have recently launched this service for NRIs to help them file their Indian taxes. Naman is one of our esteemed CA experts for that. So any of you who want to, who are looking to file taxes in India this year and need, us to help them out, feel free to, visit this link and submit your interest, and we will, help you file your taxes seamlessly. So thanks everyone for joining in. Thanks a lot, Naman.
Thank you.
And yeah, we'll be doing these sessions, frequently. We can take up some other topic next time as per Naman's availability. So, do stay tuned to our social media handles, and also join our WhatsApp group where, where we discuss these and also post about, such webinars as well as our services regularly there. So do join that to stay updated. Thank you, everyone.
Thank you everyone for your patience. Thank you.
Thanks,
Thank
Naman.
you.
Thanks, Ankur.
Thank
Thank you,
you.
everyone.
Thank you.